The All Ordinaries eased 0.2% today, and it's basically held on to the level that was reached in the first week of October, when it looked like they might find a solution to the European debt crisis. Since then, of course, each new hope has been followed by disappointment, and each disappointment followed by new hope, or at least the spin of hope. To give some perspective, though, on the current situation, here are the 4 biggest falls in history by the All Ordinaries Index: 1929, 73, 87 and 2007. Now, this one wasn't the largest initial fall. That honour goes to 1973. But this is now the worst Australian bear market after 4 years. Here are some of today's highlights. The iron ore miners fell pretty heavily. Westpac went ex-dividend, which is the reason actually that the All Ordinaries fell. Without Westpac, it would have gone up a bit. Computershare's $550 million acquisition of a big US share services business was approved by the regulator, so its price jumped more than 15%, and Orica went up 4.5% because of a good profit result. Global markets are in the doldrums too, of course, waiting with bated breath to see when Greece will default and whether Italy and Spain will too. Friday wasn't a good day in Europe and Wall Street because the G20 meeting ended in total failure, and the glum mood spread to Asia today. Now, this is a fascinating chart. It shows developed world share prices and G7 short-term interest rates. Up to 2009, they were a perfect match because they both tracked the macro economy. After that, shares were boosted by the government's fiscal stimulus everywhere, and short rates were cut by central banks as part of the stimulus as well. The question now is whether they'll join up again, because rates are definitely not going up. Finally, the Australian dollar today has slipped a tiny amount, basically in line with the share market. And that's finance.